Welcome back, everyone. I'm very pleased to welcome our next speaker for this morning, Saul Miller. Saul, welcome.
Thank you.
Great. Saul is a portfolio manager at Truffle Asset Management. They manage the Nedgroup Investments Balanced Fund for us, and they've done an absolutely sterling job. Saul, you guys are like smashing it out of the park, literally. Shall we start by looking at some of the performance numbers, please?
Sure. I'll talk about what's worked for us this year, and maybe a little bit about what hasn't worked for us, but mostly it's been a good year, so it's mostly been contributors to performance. The key contributors, and they're sort of similar for the last 3 months and the last year, have been the precious metals, so gold and platinum, or the platinum group metals have done nicely for us. We've liked the gold story. We still like the gold story, and that's really based on our view of the world fracturing geopolitically, the weaponization of the dollar, central banks buying more gold. We think there's still quite a lot of momentum behind that. Gold price has obviously done very, very well to date, but we still think that trend is in place. So we maintain that. We quite like the PGM space as well. We also think there's some good supply dynamics in that sector. We don't think you're going to be getting supply. You're going to be having some deficits that continue. So we are quite positive on that sector as well. In terms of offshore has been very good to us this year as well. There have been a number of contributors to our offshore performance. We've had exposure to European defense that has done nicely for us. We've had exposure to European financials. We've also had exposure to tech and indirectly to AI via semiconductors, not so much in the States, more in Asia, where we see more value and a little bit less risk and a little bit less of that bubble froth. So we've had exposure there that's done nicely in the likes of Taiwan Semiconductor and Samsung. So those have been some of the key areas there's been some of the key contributors, as well as China Tech, by the way. I didn't mention that, but Naspers and Process has also done nicely. And that's also another region that's benefiting from AI as well in terms of efficiency of a lot of those companies actually getting AI benefits. And once again, with valuations that aren't quite as frothy as you would see in the US. So that's been quite a benefit for us. There have been a few things that haven't worked. Anheuser has been a little bit disappointing for us. We still think it's quite cheap. It's trading on a very, very low price to cash flow multiple. So we still maintain our position there. And obviously with the strong rand, some of the offshore currencies that we hold have obviously taken a little bit of a knock, but that's really at the margin.
Saul, so you've mentioned AI a little bit just now. So what's been the impact on US economic growth specifically, please, as compared to the labor market, for example?
So the labor market has been weakening. We've seen labor demand coming off a bit. We've seen sort of lackluster payroll data. But what we've seen against that is obviously CapEx spend that's been picking up quite nicely. And when I say CapEx spend, I particularly mean software and information processing equipment that's been growing quite aggressively, which you can see in the slide. And that's really, a lot of that relates to data center spend, which obviously relates to AI uptick. So we think that's actually going to continue for quite some time. I know it looks a bit elevated here, but as you probably well aware, you listen to the CEOs of these big tech companies. No one wants to lose the AI race, so they are spending furiously. And we think at least over the short term that continues. And you're actually seeing that coming through in terms of the earnings of companies. So if you look at earnings revisions in the S&P, which have been positive over the last 3 months, you'll see that most of that upward revision is really due to the large cap tech companies. And a lot of that relates to this continuous spend in AI. The question is, how sustainable is it? For how long? It certainly should be there, I'd say, over the short term.
Good point. I mean, just to come back to the labor market a little bit and how it's been weakening, do you want to just share a bit more your thoughts of that?
Sure. So what's been unusual about this labor market is, normally with this kind of weakness in labor demand, you would have expected unemployment rates to rise up. You would have expected wages to come down, or would have expected a bit of a recession. So part of why we haven't seen that, well, we've obviously had this CapEx spend that's helping. But what's really keeping unemployment rate low is obviously the supply of labor that's been kept low. And then numerous factors that contribute to that. One of them is obviously curbs on immigration. That's obviously always helped the US in terms of keeping their labor supply up. You're not seeing that because of everything people are obviously well aware of politically in the US. You've got lower participation rates post-COVID. So a number of factors are keeping supply quite tight in the labor market, and that's why you've still got fairly low unemployment rates. But notwithstanding that, you still are seeing this weakness in labor demand, which is continuing, and I think that is going to allow some level of cuts to rates, which should be good for the economy. It might not be as much as is currently being priced into the US bond market. Expectations are for about 1%. That feels a little bit aggressive given what we're seeing in terms of economic growth, but you should get some of that, and that should also provide a bit of an underpin to the US economy and to sentiment.
And Saul, something you alluded to, valuations in the US, how's that looking at the moment, please?
So the S&P in absolute terms is obviously quite high. If we look at it on free cash flow yields, it also looks very expensive, and the free cash flow yields are very low, and that's because of all this massive amounts of capex spend that we're seeing from the large cap tech guys. But if we separate tech out from the rest of the market, what you see is that the rest of the market is still quite expensive relative to history. The tech portion is also quite expensive relative to its own history as well. And as I said, if you have to look at it on a cash flow, not on an earnings basis, it looks particularly expensive. So to justify those valuations, those very low free cash flow yields, you have to believe that there will be a sustainable return on all these investments. And that's a bit of an unknown at this stage. There's a question mark over that. So there certainly is, we'd say, a worry over valuations, but that's not necessarily going to be an issue for the next year because, as you know, valuations don't really tell you much about what markets are going to do in the short or even the medium term. They tend to have more of an impact over the long term.
I mean, it's just interesting. I'm looking at your chart now, but can you believe 15 years ago that Mag 7 versus the rest of the S&P 500 valuations were actually so close together? Unbelievable, hey?
It is quite something, but you can't deny how exceptional these businesses have been and how exceptional the growth in the earnings has been, and it's been high quality earnings as well for many of them. They're fantastic businesses with enormous moats that get huge benefits from network effects. So a lot of it is justifiable. Whether that growth can continue is obviously questionable, and whether some of this huge amount of capex spend can be sustainable at these levels is obviously questionable. And also, you've obviously got some of the potential profits that you might get from the guys that are making money out of just making the AI engines, like OpenAI. What their ultimate levels of profitability will be is obviously questionable. One of the things which you're probably well aware of is whenever you get new technologies in history, there's usually a lot of froth, a lot of excitement. Society gets the benefit of those new technologies. As to who makes money out of it is questionable. And I mean, we can go back over a century to the likes of the railways. A lot of bankruptcies, but obviously the world benefited from a lot of railway infrastructure. So there's a lot of risk around this AI theme in terms of who ultimately profits from it. So, when we're looking at it, we'd like to get some exposure here, but we're aware of the risks, and we don't want to get caught up in the froth of the bubbles, and we certainly don't want to we don't want to get caught up in businesses that might not be able to sustain profitability levels that are imputed in their share prices. So we have to be a bit careful, but that doesn't mean there aren't opportunities.
Yeah, I mean, you're talking about froth and bubbles and making sure profits are sustainable. What about earnings now relative, let's say US versus the rest of the world?
So if we strip out the tech companies from the US and we look at the earnings for an average US business versus the rest of the world, they've actually outperformed quite handsomely for quite a number of years, for over 10 years. But interestingly, over the last couple of years, US, excluding tech, has actually been flat with the rest of the world. The reason why that's interesting is that the US ex-tech is still trading at a premium to the rest of the world. So it's been justified for a lot of that period, given that the earnings have done well. But we question that now. Why should they trade at such a premium now, particularly given that we do worry about the dollar? The dollar is overvalued. Once again, doesn't mean it's going to collapse in the next year, but we think over the fullness of time, it's probably going to underperform. So that's another risk of owning the US. So we would argue that there's good reason to diversify away from the US, given that, especially the non-tech portion. And then on the tech portion, we think you can also find other opportunities.
I mean, shall we talk about that in a bit more detail now, talking about kind of investments outside of the US playing to the AI theme, considering the whole ecosystem that AI kind of feeds into?
Sure. So over here, we have a chart which looks at the expected 3-year growth versus the valuation as measured by a PE forward, a 1-year PE forward for various tech companies. A lot of them US, but actually also quite a lot from the rest of the world, particularly in Asia. So not unsurprisingly, you see a lot of growth expected out of your large cap tech companies, a lot of them involved in the infrastructure build out that's needed for AI. A lot of these data centers, you need semiconductors and so on, like the likes of an NVIDIA and a Broadcom and an AMD. So lots of growth expected here, but they're also priced on fairly lofty valuations. You know, we're sitting in sort of the high 30s. What you can get is you can get other businesses trading on half those valuations, some of them quite high quality, like a Taiwan Semiconductor, which has a huge moat. I mean, this is the largest semiconductor company in the world. Very high quality business, trading with similar growth rates, but on a much lower valuation. So that provides just a great alternative to what you would get in the US. A company like Samsung is also quite cheap. It's definitely not the same quality. Memory companies are a lot more cyclical, but it still is a good business. And it's actually, up until recently, it actually been trading at a discount to its own long run valuation because of certain hiccups in their own business that they've had, but they've managed to rectify some of those issues that they've had in terms of the high bandwidth memory chips that you need now that are being produced for data centers. So that seems to be fixed. And even now, the valuation for Samsung is not particularly extended relative to what we're seeing in terms of its competitors. So we're seeing some great opportunities to play this AI theme without the various risks that I spoke about earlier.
Yeah, it just is completely unbelievable, the amount of money that's getting thrown at AI. And then, Saul, of course, if you are investing outside the US, kind of dollar strength or weakness is actually quite important. I mean, what are your thoughts and comments on that, please?
So if you look at the dollar relative to its history on a trade-weighted basket, it is very extended. The problem with looking at currencies on an inflation-adjusted basis is that they give you an indication of what currencies will do over the very long term. They don't really help you with the short term. So, I mean, over the short term, we think there's actually quite a lot expected in terms of interest rate cuts for the dollar. As I said, market's pricing in about 1% of cuts. We think that might be a little bit optimistic, given that you are seeing reasonable growth in the US. So if those expectations are pared back a little bit, you actually could see some dollar strength. But I'd say that's quite small in the grand scheme of things. When we take a longer term view, of the dollar, we think it is quite extended. And if you're sort of taking a 3 to a 7-year view, we think you're likely to see dollar weakness, just given how extended the dollar is on a trade weighted basis.
Yeah, I mean, I think South Africans always feel the rand is weak, but it is actually surprising how mean reverting this chart actually is.
Yeah.
And then, of course, just turning to gold as well now, which often people consider either as inflation hedge or kind of a risk mitigator against volatility, for example. Gold price completely, going through the roof and, aiming for the stars. What are your thoughts on that, please? Like, do you think that's going to continue?
Well, I think there are numerous factors that are attributed to be drivers of the gold price. And as you said, one of them is it's like a fear gauge. So that's one possibility that's driving the gold price. It's difficult to determine how much is associated with that. If we look at sort of fear or risk around financial markets, you're not seeing implied volatilities. In other words, the cost of buying protection in markets, that is not particularly elevated. If we look at bond markets, yields in the US aren't particularly elevated. So it's difficult to determine whether there's a worry in gold that's driving the gold price, but that could be one factor. It does get treated like a currency as well, and then it's obviously, you'll be looking at things like where real rates for currencies are going, often for the dollar. That has often had quite a reasonable correlation with gold, so that's one possibility. I don't think that's a key driver. I think what is driving gold at the moment is more, is that it gets viewed as a store of value and it gets used as a reserve for central banks. I think that's what's really driving gold at the moment. And that's not surprising. Given what we're seeing in the world, we're seeing a geopolitical environment that is different to anything we've had in the last 80 years. It's difficult for many countries to own dollars in the way that they would have felt a lot more comfortable owning dollars a couple of years ago. Things have obviously changed with the weaponization of the dollar, with tensions that we're seeing between the US and even what used to be its allies. They want to diversify away from dollar holdings. So that drive for central banks to increase their dollar holdings is, I think, one of the key drivers that's pushing up gold. That's what's led us of late to be more constructive on gold. And we think that theme continues. We still think that gold reserves are fairly low, particularly in emerging markets. So if you see how low gold reserves are for emerging markets versus the developed world, they have quite some way to go. There's still a lot of buying that needs to take place. So gold prices are elevated, but you still have this demand. It doesn't mean that gold can obviously shoot to the moon. There has to be, there has to be some price at which they pull back. It's not clear that we are in a bubble yet. We do accept that gold has run quite a bit, so we are reducing some of our exposure in the interests of not having an excessive concentration of the portfolio just sitting in one asset class. So we are taking a little bit off the table and trying to find equally interesting opportunities. But we still broadly like the gold theme, and we think it certainly continues given this change in the geopolitical landscape, which certainly at this stage, there doesn't seem to be any reason as to why that is going to change dramatically.
I mean, it's just interesting, your previous chart. I mean, the dollar went from basically 60% of reserves to now, whatever, 44%. It's quite a big change over the last quarter of a century or so. But then, Saul, I guess just turning to PGMs now. I mean, are we past kind of peak margins, and what are the implications of that?
So we've had a bit of a run up in the PGM basket price, which at this sort of level, the profitability for the PGM miners is probably close to what their mid-cycle profitability levels have been. At this level of profitability, they're certainly not going to be sinking new shafts or expanding production meaningfully. I mean, ironically, or given the worry of slowing demand for ICE vehicles, the combustion engines, at the expense of EV vehicles, would obviously be something that worries PGM miners. They need to know that if they expand their supply, that their mine will have 20 to 30 years of life, and they are obviously uncertain about what that outlook for EV vehicles is. So although the fall off in demand for combustion engines is a worry and a concern, you're equally going to have a fall off in supply because miners are worried about that. So you've kind of got a plus and a minus, and it's delicately balanced. And what we're currently seeing is an expectation of deficits continues, which obviously creates a bit of upward price pressure. So, I mean, you're not going to suddenly, it's going to take time for EVs to obviously take over the whole world. So we think you still have quite a bit of runway where a lot of countries still need petrol vehicles, which keeps demand going. It'll be declining, but so will supply. So we still think that there's a case to be made for PGMs. The other factor we like about PGMs is the fact that it is also a precious metal. Now, I mean, one has to realize that the supply is quite limited, so it's hard for central banks to fill their vaults with platinum and palladium and so on. But that doesn't mean that some investors don't start treating it as a precious metal. So we think there's optionality there that has not played out yet at this stage. So although not our base case, there's optionality in that, and we think there's value in having exposure to the sector as a result of that, given that the prices have not really gone up much. And I mean, you can see from the chart, I've looked at a PGM basket relative to industrial metals over time, and really what this just highlights is that prices really aren't particularly extended, especially in light of the fact that they are precious metals, and secondly, that you do have deficits in these metals. So we still think it is appropriate to have some exposure here.
I've definitely been seeing like articles in the FT, for example, talking about how car manufacturers are taking increased interest in kind of traditional internal combustion engines, for example. So yeah, definitely some tailwinds for PGMs there as well. And then, Saul, I guess all this talk about PGMs and gold, what does that mean for South Africa, the rand in terms of trade and so on?
So obviously it's very good for our terms of trade. We export those metals. We import oil, which has actually been quite flat, which has been really good for us. So our terms of trade is moving in the right direction. which has been great for our currency, as we've seen. We've seen bond rates coming down quite a bit as well. Part of that has been related to the central bank targeting lower levels of inflation. So that's come through quite nicely in bonds. So some of that has pulled down bonds, and some of it's actually been the real portion of the bond rate has also been coming down as well. What's been interesting is that despite seeing bond rates really strengthening or coming down a lot, that should have filtered through into the valuations of SA companies or domestically exposed companies. And we haven't seen that. In some cases, it's justified, and in some cases, it isn't justified. In the slide here, you can see earnings revisions for some of the sectors in SA, and I've put up retail, banks, and life insurance. Now, for retailers, it's been quite a tough environment. We've seen negative earnings revisions. So although there's decent growth expected and quite nice valuations, dividend yields of 5%, if there weren't earnings revisions, that would be quite a compelling return. If you add your 5% to your 11, it would give you a sort of high teens return. But given those earnings revisions, you're obviously not getting that benefit. We're not sure when this turns. So we've generally been quite underweight or underexposed to the retailers. But what's surprising is that banks and insurers, where you're actually getting flat to upward earnings revisions, we would have thought you would have seen some re-rating. You haven't seen that. So we've actually been upping our exposure here into this weakness where we think you still will get a benefit. In terms of banks, it's obviously been quite flat, but at least you're not getting much of a downgrade, which is positive. If you look at the dividend yield and the growth, you're getting very high teens returns out of banks should things continue as they are. So that's great. On the life insurance space, you're actually getting meaningful upgrades. Some of it is because markets have done well and because the short-term insurance cycle's been quite good, but some of it's also some self-help that is expected to come through. And I didn't use the dividend yield for the life insurers, I actually put free cash flow yields. The reason being is that some of them aren't just paying high dividend yields, they're also doing share buybacks as well. So that's also great going forward. You're going to have that underpin as well, helping the share prices. And some of them look particularly generous. Some of them are on free cash flow yields in excess of 10%. So seeing quite a lot of value in that space.
I mean, Saul, you've started talking about it already. Let's rather just elaborate on some of the holdings in the fund that, let's say, your favorites that you've holding on to, and then if you can just finish off with how you've positioned the portfolio, please.
Sure. So, I mean, I've spoken about some of the sectors and themes that we've liked. There's a lot of stock-specific investments that we like within the portfolio. Some of them have more of an offshore flavor. If we're looking just at the domestic market, like the likes of a Bidcorp or a Prosus. Bidcorp's a very high quality food service business with structural growth, a very healthy balance sheet. There's room for them to do acquisitions going forward. They often have little bolt-on acquisitions. And it's trading on incredibly cheap PE. It's trading on about a 14.5 PE, which is not too out of line with some of the PEs that we're seeing in our domestic companies. And this is essentially a first world business that doesn't have the risks that SA has, yet it does have really good growth going forward. So this is certainly a counter that we've been upping our exposure. Prosus is, one of the key drivers there is obviously Tencent. And I've spoken about the fact that, why we like China tech. So here you get a reasonably priced entry into China tech. There are indirectly actually getting a bit of a benefit from AI as well. But I've spoken about that already. If we look in SA, you've got the likes of a Capitec, which is one of the few companies that's actually got growth that's not really dependent on underlying economic growth in SA. So economic growth in SA is quite questionable. It's not looking particularly good. So if you can find companies that can take market share and grow ahead of the market, that is obviously great. Capitec is one of those businesses where they're quite small in certain sectors, like in business banking, where they still have a tiny market share that can grow. And we've seen that in their recent results. Once again, just fantastic growth in customer numbers. So really certainly not suffering from the ills of the lackluster SA economy. Not a particularly cheap share, but we think the growth justifies the valuation. And Pepkor is one of the retailers that has not had earnings downgrades that's doing well. They also have some small businesses that are on new ventures that also help add to their growth, and they're quite defensive as well, given that they are at the lower end. So it gives you a sort of sense of what we like in the SA portfolio. In terms of the overall portfolio exposure, we still maintain a fairly high offshore exposure. We think it's appropriate, just diversification-wise, to have a sizable offshore exposure, just given the various opportunities that you have offshore versus SA. So we maintain that at a fairly high level. There's obviously not a lot of US exposure there, given my comments about the US market and the fact that we're seeing a lot of other opportunities elsewhere in Asia and in Europe and in Japan, to name a few. You can see that mining and resources is still quite meaningful, and precious metals obviously a meaningful part of that, given my comments about gold and PGMs that we favor. Bonds are fairly low, and that's not surprising. Bonds have rallied, yields have come down, and as I said, some of the SA equity sectors have not responded to those lower bond yields. So we prefer to have our exposure rather in equities than in bonds, where we still think there is some upside. And then a reasonable equity exposure at just over 70. We have been reducing that a little bit into this run up in markets that we've seen.
Saul, that was brilliant. Thank you very much. We appreciate you joining us today.
Thank you.